Learning Objective 18-6 to make calculations and record journal entries for enterprise funds. So we've talked about enterprise funds before. They're one type of proprietary fund. The other type is internal service funds. And enterprise funds have external customers, i.e. they provide some kind of service to the public and they charge a fee for that service. And this could be an electric company, a local electric municipal, it's called a municipal utility for electric or gas or water. I know where I live, we have PSE&G is a public. I don't know if it's a public company or I think it's a public company, but it's a publicly. It's not a government-owned company. Whereas where I live, we have Passaic Valley Water Commission, and that's an enterprise fund because what they do is they deliver water. I mean, they deliver it through pipelines, but they deliver water, and they charge for it. So the accounting for this, since an enterprise fund is kind of like a business, the accounting for this is also going to be a lot like a business. We're going to use the measurement focus based on all economic resources, all assets, all liabilities, all revenues, all expenses. The real accrual method of accounting. We're going to record fixed assets and long-term debt. And we are going to focus on determining net income and assure that capital maintenance takes place. And this is one of the two types of proprietary funds. The other is, again, is the internal service fund. And the financial statements are going to be similar to those for a regular company. So you would have what's called a statement of net position, which is like a balance sheet, a statement of revenues, expenses, and changes in net fund balance, not fund net balance. That would be like an income statement or what we call a P&L. And you're also going to have a statement of cash flows in an enterprise fund. Now here's a trial balance for Sol City Water Utility Enterprise Fund. And again, this is all from the book. I got to update the year, sorry. Anyway, the assets we have are cash, machine and equipment and buildings. Then we have accumulated depreciation on the machine and equipment in the buildings. We have a liability of a bonds payable. And we have two areas of net assets here, which is like stockholders' equity. We have what's called net assets invested in capital assets, net of debt, and then net assets unrestricted. And let me just explain how you get this net assets invested in capital assets, net of related debt. I'm going to refer to it as net assets invested, net of, I don't know, I'd like to use a shorter name than that. Anyway, that would be the machine and the equipment minus the accumulated depreciation and minus the bonds. And I showed the calculation for that right over here, how we got $17,000, not $17,000. $9,000 is everything else. Now this is going to look very familiar to you. Let's say we bill our customers $40,000. I'm going to debit accounts receivable for $40,000. I'm going to credit allowance for uncollectibles. So this is a little more like, that'd be $40,000, a little bit more like governmental here, because we're not doing bad debt expense, but we're rather netting it against the revenues. Revenue, water sales, would only be for the amount that we net expect to collect, $37,000 in this case. And then I actually collect $32,000, so I'll debit cash for $32,000 and credit accounts receivable for $32,000. And then we buy capital assets. So we're going to purchase and pay for equipment of $6,000. So I would debit equipment, just like with a regular company, and credit vouchers payable, because we're going to use vouchers payable to pay for this. $6,000. And then I've also got, I'm going to pay off the vouchers payable rather. Credit cash, $6,000. Pay for equipment, $6,000. And now I'll do some interfund activities just to see what happens. Some of this might look a little familiar to you. Receive a short-term loan from the general fund for $3,000. Buy supplies from internal service fund for $3,000. and pay the internal service fund for the supplies. So let's receive that short-term loan. I'll debit cash for $3,000. Credit due to general fund, $3,000. Then I got my supplies inventory, so I'm going to debit supplies inventory for the amount of supplies that I received. And the credit would go to due to internal service fund, $3,000. Then I'm going to pay the internal service fund for the supplies, so due to internal service fund. I'm not going to pay from the whole thing, just $2,000 of it. So debit due to internal service fund, $2,000. Credit cash, $2,000. Next, I've got various different expenses. I've got general operating expenses of $9,000. Credit vouchers payable for $9,000. And then I'm going to use up $3,000 worth of supplies. So I'll credit supplies expense, supplies inventory rather, for $3,000, and debit supplies, or they're going to call it here general operating expenses, but it could be supplies expense, could be a portion of that. And the way you would do that is you just look and see how much supplies you have left, how much you repurchased, how much you have left, and the difference is the amount that you used. I'm going to record depreciation expense. So that would be $3,000 on the building and $15,000 on the machinery and the equipment. So credit accumulated depreciation building for $3,000 and credit accumulated depreciation machinery and equipment for $15,000. And then we have interest. So debit interest expense. How much is the interest? Let's see, it's 5% on 100,000. So that'd be $5,000. Credit accrued interest payable. Just following standard accounting that we all know and love. And credit accrue interest on bonds payable for $5,000. And just for fun, we're going to do our closing entries. So I'll split my screen here. And let's go back and see the various things that I recorded. I've got revenue. See, this is the opening trial balance, so there's nothing to close there. Take our revenue from water sales. I guess we're not going to get into, we don't get into the, well, I shouldn't say I guess, we don't get into delinquent versus non-delinquent accounts receivable here. And then the various expenses, one expense I had was general operating expenses. And if you remember, we had quite a few here. $9,000 plus $3,000. And then I had depreciation expense of $18,000. And then I had interest expense of, let's see, 5,000. And the difference between these, believe it or not, is going to go to an account called profit and loss summary. So that'd be 37 minus 12 minus 18 minus 5 is $2,000. And then this is going to get closed profit and loss summary is going to get closed to retained earnings. No, just kidding. Net assets unrestricted. We have to make a little adjustment here. It's going to be a little complicated. Net assets unrestricted would be $2,000. But we got to adjust this net assets net assets invested in capital assets net of related debt. So right now, net assets invested let me make a little. Right now in this account, I have $17,000. And how much should I have? So I had additional purchases of, let's see, I bought some stuff here, right? I had additional purchases of the machinery, wherever it is. There you go. I purchased equipment of $6,000. So that would increase my long-lived assets. And then I recorded additional depreciation, which would reduce the value of those assets for $18,000. So the amount of assets, long-lived assets, would go up by $6,000, but it would also go down by $18,000 because of the depreciation. Therefore, the closing balance would be $17,000 plus $6,000 minus $18,000 would come out to be $5,000, which means that this needs to be adjusted down from $17,000 opening balance to ending balance of $5,000. And again, remember what net assets invested is. Net assets invested is your capital assets minus your long-term debt. You kind of think of it as like two different pieces of the balance sheet here because we don't have retained earnings. So we kind of have net assets that's for current assets, that'd be current. Unrestricted is like working capital, current assets minus current liabilities. And net assets invested is like long non-current assets minus non-current liabilities. So you can kind of look at it that way. So it opened up with a balance of 17. And then we bought additional equipment of $6,000, but we depreciated everything $18,000. So the net non-current assets, in other words, long-lived assets minus non-current liabilities, would be $5,000, and therefore the balance in this account needs to be reduced by $12,000 by the difference, because right now it's at $17,000, and it needs to be reduced down to $5,000. So this would be $17,000 minus $5,000, or $12,000, and net assets unrestricted would then be credited for $12,000. So then the balance in that account would come out to be, it has a beginning balance here of $9,000 plus another $2,000 here plus $12,000. So 9 plus 2 is 11 plus 12 is going to be equal to $23,000.